All right, welcome to this explainer. Today we're diving into something seriously fascinating, one of the biggest contradictions in the market right now. We're looking at ASML's Q1 2026 financial results. It's a textbook paradox, really. You've got this massive AI-driven commercial success colliding head-on with some very strict, tightening geopolitical realities. And honestly, understanding how this plays out gives us a crucial window into the whole future of global tech infrastructure.
So here's the puzzle we're tackling today. ASML didn't just meet their first quarter expectations, they absolutely crushed them. They even raised their full year guidance. And, in the week leading up to the earnings call, the stock surged, up roughly 16.2%. But then, kind of inexplicably, in the days right after they released these stellar numbers, the stock dropped over 7%. I mean, what gives? How does a company report record-breaking news and then just get punished by the market?
Well, to wrap our heads around this financial paradox, we first have to look at the physical tech itself. The machinery they build, like the NXE 3800E, is incredibly complex. Just to give you an idea of the sheer scale here, one of these machines is roughly the size of a public bus, and the price tag? Hundreds of millions of dollars each. It's this exact engineering that gives ASML a near monopolistic hold over the extreme ultraviolet, or EUV, lithography market. The tech is just so impossibly dense, backed by so many years of proprietary research, that for a new competitor to enter this market, it's virtually impossible. That absolute market dominance is the real engine driving their financial machine. Okay, let's get into Section 1, inside the Q1 numbers. Before we can even begin to understand that stock drop, we have to appreciate just how unbelievably strong the underlying business is right now. Look at the sheer volume of cash they generated in a single quarter. 8.8 billion euros in total net sales and a massive 2.8 billion in net income. Plus, they're maintaining a phenomenal 53% gross margin. You guys, that is almost unheard of for a company that builds physical hardware. And maybe the most important piece for investors, their earnings per share sits at 7.15 euros. That's a massive 19% increase year over year. Typically, fundamentals like this send a stock soaring, not sliding.
So where'd all this cash actually come from? It was fueled directly by record-breaking bookings from the previous quarter. In Q4 of 2025, ASML locked in a staggering 13.2 billion euros in bookings. And here's the kicker. Over half of that demand was tied directly to those ultra-complex EUV systems we just talked about. So we aren't talking about speculative, maybe someday growth here. This is hard, locked-in demand from the absolute biggest tech manufacturers on the planet.
And because of this surging, very real demand, ASML made a pretty major move. They significantly raised their full year 2026 revenue guidance. They bumped the previous estimates up to a new range between 36 billion and 40 billion euros. To put that into perspective, analyst estimates were sitting right around 37.7 billion. So ASML is basically coming out and confidently predicting they're going to easily surpass what Wall Street initially expected. Now, they aren't just sitting on a giant pile of cash. They are aggressively returning it to their shareholders. We're talking about an unprecedented $14 billion share buyback program running all the way through 2028. They've also proposed a final dividend of 2.70 euros, which brings the total 2025 dividend to 7.50 euros a share. In Q1 of 2026 alone, they spent 1.1 billion euros just on buying back shares. They are rewarding their investors at historic levels. All right, moving on to Section 2, the AI infrastructure play. So the real question is, what exactly is driving these insane numbers? Well, as you probably guessed, it's the global artificial intelligence boom. If you're looking at the AI space, ASML is the ultimate picks and shovels play. Think about it, during a gold rush, the folks who consistently make the most money aren't usually the gold miners. It's the people selling them the picks and the shovels. ASML supplies the absolutely mandatory, highly specialized equipment to chip makers like TSMC and SK Hynix. Then, those companies use ASML's machines to build processors for giants like NVIDIA and Apple. Without ASML's picks and shovels, the modern AI gold rush literally just stops. And to keep that gold rush humming, ASML just never stops innovating. Their newly released machine physically produces these highly complex logic and memory chips faster than ever before. It bumps the throughput up to 230 wafers per hour. This is exactly how they maintain that unassailable edge. They don't just build the best machines in the world, they relentlessly make them faster and more efficient, making themselves even more indispensable to the entire semiconductor industry. Which brings us to Section 3, the China export headwind. Okay, so if the numbers are undeniably great and the AI tailwinds are blowing this strongly, we have to get back to our paradox. Record profits, raised guidance, massive share buybacks, and an absolute monopoly on the hardware powering the AI revolution. So why the sudden 7% drop after the earnings call? What actually spooked the market?
What we're witnessing here is a classic tug of war. It's an unstoppable force meeting an immovable object. On the one hand, you have this soaring AI demand. We're talking lucrative multi-year agreements with Samsung, Intel, and a historic 8 billion euro order from SK Hynix. But pulling hard in the exact opposite direction are tightening geopolitical regulations. Things like the proposed Match Act and increasingly strict export restrictions specifically targeting China. And these geopolitical realities, they aren't just abstract ideas. They have a real, immediate impact on the bottom line. These restrictions directly threaten ASML's high-margin service and installed base management business within China. Because of that, ASML actually had to issue a slightly softer near-term forecast for the second quarter of 2026, projecting net sales between 8.4 billion and 9.0 billion euros. It was this slight short-term caution, injected entirely by international export rules, that temporarily spooked the market into that 7% sell-off.
Let's wrap things up with Section 4, the long-term outlook.
So how do we reconcile all this? How do we square this short-term geopolitical turbulence with the long-term technological trajectory of the company? Well, take a look at this quote from ASML CEO Krista Fokit, because I think it's incredibly revealing. He basically stated that the bandwidth in their 2026 guidance already accounts for the potential outcomes of these ongoing export control discussions. What he's saying is even with their newly raised 36 to 40 billion euro guidance, they've already baked in the worst-case scenarios regarding those export restrictions. The guidance isn't just blind optimism, it's actively, mathematically accounting for the geopolitical headwinds. And honestly, if you zoom out past the immediate noise of the current quarter, the sheer scale of the opportunity really comes into focus. Chips are growing exponentially more complex, and AI adoption is only expanding. Because of that, ASML projects an annual revenue opportunity of up to 60 billion euros by the year 2030. They clearly view the current geopolitical landscape as something they just need to navigate, not something that's going to derail their fundamental long-term growth story.
Which leaves us with this final, critical question to ponder today. As AI continues to fundamentally reshape the global economy, requiring ever more advanced physical hardware, will geopolitical regulations and borders act as a permanent ceiling on companies like ASML, or, as the data strongly suggests, will it just be a temporary speed bump on the path to unprecedented historic growth? It's a fascinating tug of war, and for sure, it's one we are going to be watching very, very closely.